Swayam Prabha. Digital India. Educated India.
Now let's try to see if we can solve some numericals on the bond valuation. Some simple things I have picked up from the textbook, and I have for stock valuation. So let's start with bond valuation. Let's start with the first question. Semi-annual bond valuation. I can solve it using an Excel, of course. Yes, I can solve it manually also using equations, not a problem. Now let us see semi-annual bond valuation. Consider a bond with a coupon rate of about 8%. That pays a semi-annual, what do we call it, as the semi-annual interest, and matures in 8 years. The market rate of return on bonds of this risk is currently at 11%. What is the current value of the $1,000 face value bond out there? Let us try and solve it with the help of an Excel. We know the formula for bond. Coupon rate is 8%. But please note, it is semi-annual. That means what? It pays twice in a year out there. So what happens? Market rate of bond is 11%, maturity is 8 years, face value is 1,000. That is all fine. So if it is 8 years, how many coupons will you get? You will basically get, how many coupons will I get? In 8 years, I will get 16 coupons in 8 years because it is semi-annual, and that is where I said semi-annual payment 16. What is it you are going to get? 8% on 1,000. At every stage you are going to get semi-annual coupon of $40 out there. So annual coupon of $80 out there. Average market interest rate is 11% and semi-annual. So what happens when we say semi-annual? It is 5.5%, just half of it. Now what is interesting here? Please note, the interest what you are getting every 6 months, that is getting compounded again, because this $40 what you are going to get on 30th of June, imagine 30th and 31st of December, June and 31st of December. You have the option of reinvesting that $40 for the next 6 months at the rate of about, what do you call it as, at the annual rate of about 11%, or you can earn about 5.5% on that $40 for the next 6 months out. So what happens? Your total return that you are going to get is not 80, is $80 plus a 6-month return on the $40 that you got on 30th of June. So your total return will be a little more than $80 out. So in a semi-annual payment. Sir, will it increase if it is quarterly payment? Of course, yes. Will it increase if it is a monthly payment? Yes. So what happens? When you say, how am I compounding? Am I compounding it monthly? Am I compounding it annually? Am I compounding it biannually? Oh, sorry, say in this particular semi-annually. Am I compounding it quarterly? Am I compounding it monthly? That depends. That can vary, or that can act as a differentiator in your return out there. That can basically tell you your net return out there. So the terms of coupon payment becomes very, very important. In this case, it is semi-annual. So let us look at what is the market value of this bond out there. I am going to do it in both the cases. Let us sort of see it. I can use an Excel function. I am not going to use an Excel function out here. Let us do it. Let us calculate what is the face value of this bond out. First thing, face value of the bond. That is what we talked about. That is the second part of it, face value of the bond out there. Face value of the bond is, I am going to get $1,000 out there. Present value of the face value of the bond divided by 1 plus divided by 1 plus. Please note, I am going to earn at the rate of about semi-annual rate of about 5.5%. Though annual rate, market rate is 11% out there, my semi-annual, because it is getting compounded every 6 months out there, I am going to earn about this to the power of, I'm not going to get 8 payments. I'm going to have 16 times out there. To the power of 16 is basically what I will take into consideration at this stage, and this will be the face value of the bond out there. This is what will be the face value of the bond out here in this particular case out there. Now, what is the present value of the annuity? Please note, what is the present value? Because see what did I do out here in this case? Because number of T is not 8, T is 16. Because you are going to get, it's going to get compounded every 6 months. Now let us look at annuity. What does annuity say? Start with in the first part of the formula out here. See the coupon. What is the coupon out here? The coupon I am going to have in this particular case is $40 semi-annual into 1 minus parenthesis divided by 1 plus 1 plus R to the power of T. What is R? Again 5.5%, again to the power of what is called as 16 out there, because I am looking at it. I am looking at it in this particular case of semi-annual out here in this case. This whole thing divided by what is called as my R, again my 5.5% in this particular case out there. My present value of annuity is about 418.49. My value of the bond is 843. Go to the second problem out there. Second problem is zero coupon bond. What is the value of a 20-year zero coupon bond with a face value of 1000 when the market required rate of return is 9.6% compounded semi-annually? Please, again, I am taking all these are compounded semi-annually in this case. Maturity is 20 years. Face value is 1000. Market rate of return is what we call it as your market required rate of return is 9.6 and compounding is semi-annual out here. Let us look at the bond value. That is my face value divided by 1 plus my interest rate divided by 2, because what I am doing is because it is semi-annual, whole thing to the power of 20 years into 2, because it is going to be paid semi-annual out there, and that is it. It is going to be about 153.30 is the value of the bond. Semi-annual means what? I have just like in here compounding, like in here is doing that. Let us go to the third question out there. We will solve 3 and 4, and then I think the rest 4, 5 and 6 you guys can solve it by yourself. The bonds issued by Manson and Sonbear and Manson and Son bear a coupon rate of 6% payable semi-annually. The bond matures in 15 years and under face value of and has a $1000 face value. Currently, the bond sells at par. What is yield to maturity? Very simple in this case. If I looking at, since the bond sells at par, the yield to maturity will be the same rate at which what you call it in this particular case at which the coupon rate is there. The coupon rate is 6%. The bond is selling at par. If the bond is selling at par, my YTM will also be 6% out there, and that's all what we have to calculate. Look at, no calculation. Next, I look at the last numerical out here, the fourth problem out here. Rest of it you guys can sort of work on the rest of it out here. I am just going to look at one more. A corporate bond has a coupon of 7.5% and pays interest annually. Please note here annually. The face value is $1000 and the current market price is 1108.15. The bond matures in 14 years. What is the yield to maturity? What is the yield to maturity? Simple thing use an Excel, all these things out here. Let's use an Excel out here. What is this? This can also be solved using goal seek function. I will come to that a little later. Let's use an Excel function out here. Let's use an Excel function out here. All that I will do is yield settlement, yes, comma, maturity, yes, comma, rate 7.5%, price 110.18, redemption 100. What is the frequency? 2 out there. I just do this and then, well, I have the yield at 6.33%. You can also do it using a goal seek function out there by doing the present value and the face value out there. I'm also going to teach you guys how to do it. Face value is nothing but $1,000 you're going to get at what? 1 plus. There is going to be a yield to maturity. That's what you don't know what is the yield to maturity. That is going to be your discounting rate out there. I'm just clicking that cell to the power of what do you call it as 14 years out there, and this is basically what we are actually looking at in this particular case out there, to the power of 14 years out there, and this is what. We don't know what is the goal seek, we don't know what is the YTM. I'm just keeping it as 1% as of now. Let's find out here. Now, what is the present value of the annuity? If I keep that, my present value of the annuity, I set this at 1 generally. We will have to calculate the YTM. We will calculate the price of PV of annuity. PV of annuity we look at in this particular case the face value into the interest rate, that is what is the coupon out here, that is what is basically the coupon, into 1 minus 1 divided by 1 plus D39, the same cell out there, YTM, to the power of what we call it as the 14 years out here, and then the bracket close, and the entire thing divided by what we call it as the YTM out.
1 minus.
Oh yeah, 1 minus. I'm sorry, I should have made minus out here, minus. Now that I have done this, I want to see what is the YTM. Let me go to the data part of it and let me go to what if analysis and let us say goal seek. What is the set cell? Set cell is, this is the set cell. Now what is the value? Value of the bond is given as 1108.15. I will say 1108.15. By changing which cell? By changing this cell is what I want you to calculate. Yes, I have got it. It comes at 6.31%, and that's exactly what we got, around 6.33, some decimal errors out there. So 6.31 and 6.33%, around that is what we have got out here using a goal seek function. You can solve it, but ideally just use the yield function in Excel and simply calculate it. This I just wanted to show it to you, only that because it can also be done in this format. The other sums 5 and 6 you can solve it on your own. Take it as exercise. Pick up the textbook, the prescribed textbook. There are a lot of problems in the exercise. You can skip solving all the exercise. Now let's go to some problems in stock valuation. I think I have a list of about 9 problems. I'll pick up about 3 or 4 from this and we will try and see if we can solve it. Let us look at the problems and negative. First one, constant growth. Ignore, you can solve it. I'll do the second one. That's all. How much are you willing to pay for one share of stock if the company just paid an annual dividend of 1.03? The dividends increase by 3% annually and you require a rate of return of 15%. Your annual dividends of 1.0609. next annual dividend, because what is the dividend out here in this particular case? The dividend is about 1.03 is your dividend. So, it is going to grow at 3%. So, I have taken the growth, that is 1.03. Let me solve it out here. I'll add one more thing, one more row out here, that's not a problem. My annual dividend is 1.03. My next annual dividend is going to be this plus this into what you call it as the 3% out there. That is what it's going to be in this particular case. My required rate of return is 15%. So, what is it? What is the price for stock? Whatever is the next dividend I am going to get, divide by my rate of return minus the growth rate that's basically going to exist out there, and that's all. My price for stock is about 8.84 is what I'm going to pay. Go to the next problem. Unique stores common stock pays a constant annual dividend of 1.75 a share. What is the value of the stock if the discount rate is 13.25? Very extremely simple and straight out here. This is the dividend divided by this is the discount rate, and that's all what we have. Your stock is about 13.21 in this particular case out there. I go to the 4th and 5th, you can do it, 4th, 5th, 6th, you can do it, it's the same. 7th, let's go to 7th, jump to 7th. Firm's growth rate, that is, I talked about return generation and growth. Leicester has a return on equity of 11.6%, a profit margin of 6.2, and a payout ratio of 35%. What is the firm's growth rate? ROE is 11.7, profit margin is 6.2, payout ratio is 35%. If payout ratio is 35%, what is the growth? What is the retention ratio? Retention ratio is 1 minus the payout ratio out here. Retention ratio is 1 minus the payout ratio. Payout ratio, that is what is the retention ratio. Multiplied by what is the return on equity, not the margin. That is going to be about growth rate of about 7.54% out there. The firm is going to grow at the rate of about 7.54%. The price earning ratios. Rudy's stock is currently valued at 28.40 a share. The firm had an earnings per share of 1.86 last year and projects earning of about 2.0 a share, 0.9 a share in the next year. What is the trailing 12 months price earning ratio? What is the forward price earnings ratio? Trailing 12 months and forward. Number of shares is 28. Current value of the share is 28.4. Last year is this and current year is this. Trailing 12 months, past share price divided by the last year's EPS out there. Forward share price divided by the projected EPS out there, that gives you your forward EPS ratio. Last one. Russell has an annual revenue of 387,000 with cost of 216,400, depreciation, tax rate at 21%, debt outstanding with about 182,000 along with 9,506 of $67 each. Firm has a cash of 48,000, of which 29,500 are required to run the business. What is the EV to EBITDA ratio out there? I have just written down all these things. Now let us look at the enterprise value. What is the value of the enterprise? Market value of the debt plus market value of the equity, number of shares into price per share. Number of shares into price per share. less the cash balance, that is the excess cash balance. In this case, cash balance is 48, but I need 29,500 to run the business. That means what is the excess cash balance I have out there? This is the enterprise value. What is EBITDA? Very clear. My revenue is given out there minus my cost is also given out there. My cost, this is the EBITDA. What is EV to EBITDA? That's all. Express it in the form of a percentage. Yes, I can express it in the form of a percentage. Okay, with this, we close valuations of equity and bonds. We move to the next stage, that is a little more on what we call it as the, a little bit on the valuing, looking at what we call it as the alternative projects and so on and so forth over there. Or we talk about as what we call it as the making capital investment decisions. That is what I said. We looking at the alternative projects, capital investment decisions. How do you make investment decisions?